Hey guys, Toby Mathis here, and today we're going to talk about a passive income playbook using cash secured puts to get into a position, dividends, and calls while you hold on to the position. And it really comes down to this. What if you could get paid to wait to buy elite companies? And then what if you collect monthly or quarterly income while you hold them, and you still get to participate in the upside without having to gamble on which tech giant is going to win next, right? So this is my three-part blueprint using Dividend Aristocrats and Kings, cash secured puts to enter a position, and dividends plus covered calls to get paid while you own a position. Plus, there's an easy button ETF, I'll talk about DIVO, that is actually, we'll go over its performance since its inception. But anyway, I wrote the book Infinity Investing years ago about how thousands of my wealthy clients make and keep money year after year. And it became a bestseller and won a gold medal at a Global Book Award. In fact, if you want it, just type free book below and I'll send you a free PDF of Infinity Investing, which explains really in basic language how the rich get richer and how you can do the same. It isn't rocket science and it doesn't have to be risky. If you want to gamble, go to a casino. If you want to be wealthy, do what wealthy people do. They have multiple streams of income, so should you. So let's start with an easy way to build ultimate or multiple streams of income with stocks. Like you could do this tomorrow. And yes, you heard me right, you can do this with stocks. You can create multiple streams of income in the stock market right now. So let's dive in. Number one, why this works and the stock picking roulette, why that doesn't, right? Over long stretches, most active cap managers trail the S&P 500, which is just a big index of 500 companies. There's this SPIVA scorecard, which shows that roughly 2/3 of money managers, these guys that make millions of dollars a year, underperform the S&P in any given year. If you go 3, 4, 5 years out, you're talking about 75% underperform. When you get to about 10 years out, 90%, and then when you are over 10 years, really when you're 15 years and longer, it's 90-some% that underperform the market. So the longer you go in, the harder it is for stock pickers to win after you add in their costs, right? Meanwhile, index returns have grown highly concentrated. The so-called, what they call the Magnificent Seven today, represent a very large share of the S&P 500 market cap. And when you add the tech and communications sections together, services together, you get a big chunk of the index's weight. So translation, miss a few mega caps and you are going to lag the S&P. Own only them and you're very concentrated. So our goal, dependable income first, reasonable growth second, and far less guesswork. We want to take all the risk out of it to the extent we can. Remember, multiple streams of income, not buy and hope, please let my stock go up. We're not going to do that. So let's start with pillar one. Your core is you're going to invest in things called aristocrats and kings. And this is what they are. Dividend aristocrats. They've been increasing the amount that they pay to investors, what they call a dividend. They're paying out their profits typically, right? But they're paying you a dividend as a shareholder year after year. They've been increasing that amount year over year for at least 25 years. And these are billion plus market cap companies. These are big companies. And then there's dividend kings. Same thing, but 50 years plus. These are deliberately boring cash machines with pricing power and discipline, and we use them as our shopping list. Let's talk about this. Number one, our quick screening. I favor strong free cash flow coverage for dividends, modest payout ratios, conservative balance sheets, and business you actually understand. Like, who doesn't understand Coca-Cola? Well, they've been increasing their dividends for 60 years plus, and we can see they actually make money. What we want to stay away from is companies that aren't making money, but they're still paying out dividends, right? There are those out there that are leading you in. They're just kind of leading you in. That's why we go with companies that are 25 plus years, aristocrats, 50 years plus, kings. And these are the names you want to own when they're on sale. So let me explain how dividends adjust the price and actually smooth out returns. So when you're valuing a company and it makes money, let's say that we have company A, let's just use, hey, they made $1 million of profit and they keep it in the company. That shows up in its share price, right? Because now it has an asset and people will buy companies just because they hold assets. And so it starts to make the company more valuable, right? But what if instead of holding it, they paid it to you? Well, okay, I got the $1 million. If I'm the shareholders, I got the $1 million out. That's fantastic. But on the same token, people are going to say, well, it just devalued itself. It's not that it devalued itself. It quit having a spike up because it's paid it out. So it keeps it pretty steady Eddie. You have the money. And you have to ask yourself, would I rather the company have the money or would I rather have the money? I mean, there's a situation where you say, maybe I'd rather the company have some money because they're buying other companies. I get that. But what if I want the money to live off of or to do other investments? That's what dividends are about. That's why we invest deliberately into dividends. If I want that cash flow, then I can choose what to do with it. What if I take that cash flow and invest it in real estate? What if I take that cash flow and pay my expenses? What if I take that cash flow and buy Bitcoin, right? There are things I can do with that cash flow versus, hey, it's just stuck in the company. And the only way I get paid on that is to sell the company. Well, technically you could lever the company. You could use a security-backed line of credit and borrow against it, which we still do. But I want the cash flow. I want that cash flow. And my clients that are wealthy, and I'm talking about tens of thousands of clients over the years, watch them. We do over 10,000 tax returns a year for investors here at Anderson. And you can see the people that have consistent cash flow are the winners. The people that have multiple streams of income are the winners. So let's talk about pillar 2 of this strategy, which is getting paid to wait. We start by doing something called a cash secured put. I am going to make money without even buying the company. Instead of chasing a stock up to buy it, sell a cash secured put at the price you already like, typically 30 to 45 days out. If the shares stay above your strike price, the option expires and you keep that money. I literally have clients that make money year after year, month after month, week after week, selling cash secured puts. And all you are is you're selling someone the right to make you buy that company at the price you want to buy it at. So it's like if I walked in and I saw a car and it was a $10,000 car and I said, I want to buy that car at $10,000, and somebody says, but I'll pay you to make you buy that car at $10,000, I'll give you $500. You'd be crazy not to take it. Now, if the shares dip below that price, then you're assigned it. So let's say that car became worth $9,000. Okay, you already got $500. Somebody can make you buy the car at $10,000. Now the car goes down to $9,000. Okay, you would have bought it at $10,000. Now you still buy it at $10,000, but you've got the $500 in your pocket. That's just an example. So if your shares dip below that strike price, you are assigned that price and your net cost basis is lower because you got paid to buy it. It's just like the car, right? I got the $500, I keep it in my pocket. So what did I really buy that car for? $9,500. I would have bought it at $10,000 no matter what, right? But now I get to keep that money. And if I did that month after month, I could end up making a substantial amount of money. Either you get paid to be patient or you get to control your entry. So over and over, clients have marveled that they can make, usually it's about 1% to 2% per month without even owning the stock. In fact, I was talking to Eric Dodds. He runs the trading room for Infinity Investing, and he was telling me about one client who sold cash secured puts repeatedly over the last year. And on only 2 occasions in the entire year, doing this week after week, did they have to buy the stocks. That is somebody literally getting paid each week, selling someone the right to make him buy a stock at a price that he wants to buy the stock at, but only having to buy the stocks twice, but getting money consistently and constantly. Yep, it's kind of a brain twister, right? But the market is filled with gamblers. You want to be the casino, right? So by the way, if you type in free book, not only will I send you a free PDF of Infinity Investing, yes, it's a real book, yes, it won awards, yes, it's been translated into multiple languages. By the way, just go to Amazon and check out the comments, right? It's done very well because it's very easy to read. But we also will invite you to a free workshop on this strategy. We call it the wheel strategy and more. Yeah, you can. It's free. People say, why do you do that? I'm a tax attorney, right? I'm one of the founding partners of Anderson Business Advisors. But I believe that everybody should know how this stuff works. Plus, as a tax attorney, I need you to have tax problems so you'll hire us, right? I need you to have assets to protect when we do asset protection. I need you to have money for your legacy. So making money is almost always a prerequisite. So let me help you with the money-making part. Then we can teach you tax strategies to keep most of it. And I'll show you a little bit of that. But back to the topic at hand, right? Pillar 3, get paid while you hold. Dividends plus covered calls. This is multiple streams of income 101. So once you own the shares, so you sold the put, now you have to buy it, now you own the shares. Now you're going to layer in something called a covered call. It's selling some of the option to buy that share at a price higher, we call it out of the money, usually in 30 to 45 days on that part of the position. So let's say that you bought 100 shares of company A at 30 bucks. Now you might sell somebody the right to buy it from you, it's called a call, for $32.50, right? You get to keep that money. If the company goes shooting up, they might call you out. But no matter what, you keep the dividends when that's being paid out. No, you want to be the casino. You want to be in the 90% plus that get paid all the time. Speaking of getting paid all the time, is there an easy button version? Like, hey, Toby, I don't understand what you just said. It sounds interesting. I want to get multiple streams of income, but isn't there an easier way to do that? And yeah, my buddy Kevin Simpson he runs an ETF called DIVO. And let me explain what it is and what it's done. So if you like this strategy, I call it the wheel, or we call it the wheel over at Infinity Investing, but you don't want to trade options yourself. It's scary to you, or you don't know enough, or you want to learn it, but in the meantime, you'd still like to participate. There's an ETF, it's a bucket of stocks, it's called DIVO, D-I-V-O. It's Amplify CWP Enhanced Dividend Income ETF, that's what it's called, Capital Wealth Partners. It's a professional implementation of the dividend, growth blue chip stocks, plus tactical covered calls. It's targeting income from both dividends and option premiums while keeping potential for capital appreciation. It's actively managed by Capital Wealth Planning with Kevin Simpson, and he's the portfolio manager. And I've had Kevin on my channel before, and he is a great guy. He also wrote a book, I think it's called Walk Towards Wealth. I've read it, but I believe that's the title. And note, it's walk towards wealth, not run, right? You walk, you get rich slowly. Don't do the get rich quick, the get rich quick, there we go, get rich quick crap, right? It is that. You're gonna make mistakes. The odds are not in your favor. It's not like you're just gonna get hammered if you try to do something and make a lot of money, but it's highly unlikely, right? You're highly likely to make money when you do it the slow way. And if just going back into DIVO, they have a prospectus out, you can go read it yourself, but the primary objective they always state is current income. Secondary is capital appreciation. And basically they invest in high quality, dividend paying S&P 500 names and opportunistically writing covered calls on individual stocks. The sub-advisor explicitly seeks income, usually 2 to 3% on dividends, plus 2 to 4% on option premiums. So remember, you're getting paid the profit from the company, plus you're selling options for someone to buy it from you. You get paid on both, and they start to add up. So if on that one, DIVO, just read the prospectus and for details and risks. including the fact that call writing can limit your upside. Like if the thing rips off, yes, you've limited your upside to a certain extent, but boy, it's done really well. And so, in fact, I think its results since its inception, which it started in December of 2026, so right at the end of the year. If you look at its annualized total return, the NAV, it's over 12%. I think it's 12.1 to 12.6. I think it's 12.6 through the mid part of this year, of 2025. Providing and reporting varies by, there's a cutoff. But if you put $10,000 into DIVO, you would have, when it started, you'd have almost $30,000 now, right? It just keeps going up. Now you're going to say, well, I've heard the S&P did really well. The S&P does well too, but I want income, right? I want income. So income today, the trailing 12-month distributions, it's right around 4.6 to 4.7%. Yeah, it moves around a little bit because you have dividends and option premium, but DIVO pays this monthly. You get paid every month, which is really important. And just a note, yes, distributions can also include return of capital in certain months. Like they want to make sure that you are getting paid. Like a lot of people that put money into these things, they want to live off that income. They want to know they're getting paid. So this is why do-it-yourself income first is a great playbook. This is why you should learn this stuff. Cash flow steadies behavior. Dividends plus option income help you hold quality names through the noise. The market's going to crash, this, that, and the other. I don't care. I don't have a ticker signal over my house. I don't want that stress. But somehow we think it's okay to do that on our stocks and stuff. I don't want the noise. People have talked about, well, you could have put it in Bitcoin and boy, you would have made this huge amount. You would have gone up, then shot down, then gone up, then shot down. You would have had 50% drawdowns. Tell me you wouldn't have been freaking out and selling during some of those, or you would have had a six-figure growth years that you're not going to sell during those. Like human behavior says, I'm going to do weird stuff when there's huge swings and big volatility, unless you have ice water running through your veins. And so this smooths it out. This smooths it out. You don't have to guess on what's going to be the next mega cap. You just compound your returns via cash returns from durable franchises. This is also valuation discipline, right? Cash secured puts force you to pre-decide a price you're happy with. You're not just chasing a company. You say, this is what I'd like to buy it at. I am going to sell someone the right to make me buy it at that. There's also something called risk shaping, right? Covered calls can smooth out that volatility and lower that effective break even. If I'm selling calls each month, then the amount that I actually have invested gets reduced. When I'm getting back dividends, the amount I have invested technically is reduced. Like if I own a company for 10 years and it's paid me more than I paid for it, I'm good. It's gravy. There's also something called cost control, right? You don't have to pay all these expert fees, right? And remember, the SPIVA report card, the odds over 5, 10, 15 years speak for themselves. You are better off just putting yourself in a bucket of stocks. And I would just suggest that you use this strategy because it's going to create income for you. All right, so here's an easy checklist that you can put right by your desk. Number one, build a watch list from Dividend Aristocrats and Dividend Kings, the companies that pay out 25 years plus, 50 years plus, consistent profits that go up every year. There's very few of them, so you can very easily build a watch list. Number two, pick a fair value of some of the companies, things that you would own, that you're like, I would like to own this at the price it's at. And maybe you sell a cash secured put 30 to 40 days, days till expiration, near that price, maybe slightly below that price, whatever it is, you're going to get that money as number two. Number three, you might get assigned, which means you end up having to buy the company. Maybe it drops slightly and you end up getting both the money that you had from the cash secured put and now I own the company. So it's great. You got discounted shares. Not assigned. Hey, they didn't get assigned to me, so it stayed at the same price or it went up slightly. Keep that premium and do it again. Month after month, you get to keep that money. Now, if it's assigned and you end up buying the company, number 4, while you are holding it, collect those dividends and sell covered calls. That's all it is. Now I'm just renting out that stock and I get to keep that money. Usually it's out of the money, like you're selling it for more than what you paid for. And worst case scenario, you get called out, you made money on the cash secured put, you made money on the growth of the company, and you made money on selling the covered call. Not too bad. You have multiple streams of income. Number 5, recheck positions quarterly. Mind your ex-dividend dates when setting calls so that if you want that dividend, make sure you don't get called out. You roll that call, you learn all these things, and I'll give you another way how you can learn them. And then number 6, rinse and repeat. Let cash plus compounding do all the heavy lifting. So let your cash plus let it compound, let my call premium, all that stuff come in and do all the heavy lifting for you. Now let me tell you the risks, and I'm just going to do this in plain English. Look, options entail risk. You could get assigned the company, you could have an early exercise if you sell that call, and you could cap your upside. If something just takes off and you sold a covered call on it, you know, you're going to get that profit for the amount of the call, but you're going to get called out and you're going to get that profit plus you're going to get to keep your call premium. But that does cap your upside in some cases. Covered calls also don't protect against large drawdowns beyond that premium received. So if the company just tanks, it doesn't protect you from that. Although the longer you do this, you might find that you don't have a lot of basis in that stock anymore. Like you've gotten so much call premium, you've been doing this so long, you're not too worried about it. Also, distribution rates for funds vary and may include return of capital. There's a lot of these high yield funds now, and that's what they're doing. They're giving you back your money. They're not actually giving you a dividend. So make sure that you read prospectuses and understand tax treatment and that you have a strategy fit for what you want to do. Right, I hope this piques some interest. Share this video with anyone who wants to learn the way to make cash flow off their stocks. It's multiple streams of income is the name of the game. This is not get rich quick. This is get rich slow, but it happens faster than you realize. Like and subscribe and leave your comments below, and remember to type free book in the comments section for your link to a free PDF of Infinity Investing. If you really like paper and you like holding the actual book, I'm one of those guys. I love having the actual book. Just look up Infinity Investing on Amazon and you can buy it and get a physical version, or you can go to your local bookstore. We've gone through several printings, so they should be available. Until next time.